So we're back here at our house in Mar Vista, and you guys are probably wondering, like, what are we doing back here? Yeah, like, did we move in? Why are we spending so much time here? And there's a couple reasons. Number one, Kaya needs a yard to play in, a little change from her normal outdoors. And then also, it's kind of like a meeting point between where Max lives and where I live. I'm in Santa Monica, he's in Delray, so it's a good midpoint for us to meet up at. So we're here today. We want to talk to you guys about some of the current state of the market, current events. Obviously, there's been a lot going on in the financial markets right now. We wanted to get into where TGG is at and what our game plan is. Currently, it's middle of March, and we wanted to give you an update.
Absolutely, and we launch like a newsletter every month where we talk about deals that we're buying, deals that we maybe just completed, sold. We talk about recent events. We talk about our upcoming events for you and us, for you and I at the Goldfinger. But this week we wrote actually a letter to our investor base of like what's going on today and where's TGG at. And I think we wanted to do it face to face on camera and talk about, okay, this is what's going on. There's obviously, and we've been talking about it, there's so many risks in the market today, in the economy that we'll cover. And we want to share what does that mean for us? How does that A, impact our business, and B, what are we doing about it? And I want to stress again, and I think this is something we've been sharing as interest rates have gone up, even during the pandemic, right, as we've been facing all these different factors, things going on that have been impacting real estate, is like we're going to keep buying. I think that's like number one, is that we're going to keep buying. We're just going to adjust based on the risks that we're facing today.
I would just put a caveat. We're going to keep buying subject to we can find deals in the market where we feel that the pricing that we're paying is adjusted for the risks that we're absorbing by buying in a market like today. So there's obviously interest rate risk. The interest rates have kept going up, and it looks like they're probably going to keep going up. There's obviously a lot of fear right now in terms of the financial markets. Various banks have shut down. And within Los Angeles multifamily, there's a couple banks that we used to go to for loans that have said we're no longer lending on apartment buildings in Los Angeles. So there's a lot of risk on the debt side. And then with City of Los Angeles and the County of Los Angeles with eviction moratoriums and all of the laws that seem to be stacked against us, there's additional risk being a landlord in Los Angeles. And then, so what do we have? Interest rates, debt, owning in Los Angeles, construction costs have gotten higher. So it's kind of like everything stacked against us. So some people may want to know, why are we still buying and why do we have the outlook of, wanting to add to our local portfolio?
Definitely. And actually, I watched a CNBC video for what it's worth, if you view them as a credible source or not, but they were talking about rents. And they looked at rents of actually, going into COVID, they were rising steadily. We've talked about this a lot. COVID, they dropped, they rebounded and continue to rise over the past, 18 to 24 months. And we've actually seen, we were saying that rents were plateauing, that the rental market was stabilizing. We've actually seen the rental market maybe drop a little bit, kind of hover in this range that it's been at for the past six to 8 months. And you wonder, specifically in LA, is it all the rain? Is it coming off the holidays? Like, we're not exactly sure, but the facts are the facts, that the rental market has also slowed quite a bit. It's taking longer to lease, and I think we're not getting the rents that we were maybe getting 6 months ago. Versus 12 to 18 months ago, I think we're actually slightly higher. We had some buildings that we leased middle of 2022, and we're releasing those units, and we're getting about $100 or $150 more a month. So the question is, why would we still buy? And I think we look at history, right? History tells us, eventually the economy rebounds. Is it a guarantee that it's going to happen? No, there's no guarantees, right? But it shows us that the U.S. economy will rebound. People who didn't buy after 2008, people that didn't buy during the pandemic, people that didn't buy the 1990 REOs when banks were taking back properties and you could have gotten buildings at 30, 40 cents on the dollar, all those people are kicking themselves. Why didn't I buy? Mm-hmm. The truth is that you got to have the stomach, you got to have the diligence and the discipline to buy today. And I think that's like a big thing for us, is that we're not, and we keep saying this, is like we're not going to be aggressive in terms of just buying anything. We're going to be super aggressive to find the deals that are price adjusted to offset risk. And it's not just price, it's location, it's the tenant base, are the tenants paying, not paying, what can we do to the property, the condition of the building, right? We canceled escrow on a property because we walked in, and we were just like, no, we can't buy it. There were so many issues, so much deferred maintenance, and we said it's not worth the risk today. So
I have so many thoughts, but I didn't want to interrupt you, so now I lost all of them. I don't have nothing to say. But yeah, I think what differentiates us from some of the other active buyers in the LA apartment market is that we're still at the table, whereas a lot of other groups have said, I'm out. Yeah. Like if you have a deal in LA, and maybe it's because they're larger groups and they're more diversified into different markets, and they said they want to concentrate their energies into other investments, other markets. But for us, we're local, we're here in LA, and we want to keep building our portfolio here. So the short answer that we'll keep reiterating is yes, we're still buying, as long as we can mitigate the risks. So I think we can talk about how do we mitigate these risks. Well, we make sure that we're buying at cap rates that are adjusted for today's interest rates. We buy properties where we feel confident, we've done enough due diligence that we know that we can execute a business plan. The days of going in and rolling dice and saying, hey, let's hope for the best and try the best we can, those days are over. There's just too much risk for us to do that. So we need to be getting deals at either prices that adjust downward so that we can absorb those risks or do enough due diligence on the front end. Right now we're buying a few properties in Silver Lake, and we've done enough due diligence on the front end that we know that we'll be able to execute our business plan. We talk to our architect to see what we can do with the units. We see, can we build additional ADUs? What is there that we can do to add value so that we can still be profitable on these investments? And the other reason is because, like Max was saying, if we know we're going to be owning these properties for the next 20, 30, 40, 50 years, then why not buy them when we can get them at prices that are 20, 30% lower than where they will be in a couple of years from now? That's obviously coming in with an assumption that the market's going to rebound, the market's going to eventually bounce back to where it was. And the reason that we feel strongly that it will is because if you look at surveys from across the country, there was a recent survey done, I think it was the National Association of Realtors, and it said that about 1 in 5 people across the US sees Los Angeles as their dream destination of where to live, right? So about 20% of the population across the country would love to live in Los Angeles if they could make their way out here. There's beautiful weather outside. We have Hollywood, we have the tech industry.
The beach.
We have the beach. We have 300 days a year, although it may not feel like it because we've had so much rain this winter, which has been somewhat of an anomaly for us, but 300 days of the year, it's beautiful weather, and people want to, it's just a beautiful place to live. Obviously, we have our issues, and unfortunately, the homelessness has gone out of control, but long term, people will continue to want to live in Los Angeles. So we feel strongly that over time, and I don't think that there's a lot of people that would disagree that over a 20, 30 year period, Los Angeles will be a strong market. And so we feel that if we're going to own these properties for a really long-term period, why not buy them when we can get significant discounts, so long as the risks that we're taking on are mitigated by the price.
And the discount supports the environment, the market today.
Right.
And one other note that I'll add, especially with our business plan, is we're buying mostly existing multifamily properties, fixing them up, making them nicer, increasing their value. We're building ADUs. And another article that I read today, which was big on when we were electing a new mayor, is they were talking about creation of new housing, right? Development. And I think LA ranks like 39th of all the cities in the country, which is absurd because everybody wants to live here. So we're not increasing housing at the pace that people are moving here, which means there is the demand, the supply doesn't meet the demand. So if you have the current supply, the existing supply, you're going to be able to meet the any demand that's coming in. So there's going to be such a demand from renters, from people who are moving here, because we're not supplying new housing for them.
Yeah, I think that sums it up. We were trying to keep it under 5 minutes. I don't know that we achieved that goal, but either way, thank you guys for watching. If anyone has any questions, comments,
ask Kaya.
She's ready. She's ready for you. But yeah, feel free to reach out on Instagram at the Goldfinger Group, at Hu Eliyahu, Max at thegoldfingergroup.com.
We'll see you next time.